Good morning, students. In today's session, we are going to discuss about the Japanese candlesticks with regards to the continuation of the technical analysis session. Before we deep dive into the Japanese candlestick, let us understand the historical development of the candlesticks. The Japanese began using the technical analysis to trade rice in the 17th century. While this early version of the technical analysis was completely different from the US version initiated by Mr. Charles Dow around 1900. Many of the guiding principles are very similar to the Japanese method. The what is the more important than why. The what represent a price action and the why represent the news, earnings, and so on. All known information is reflected in the prices. The buyers and sellers move markets based on the expectations and the emotions, which are the fear and the greed. The two most powerful emotions in the price segment is the fear and greed. The markets intend to fluctuate at a higher to lower level during extremely volatile conditions. The actual price may not reflect the underlying value, which means that the intrinsic value of the stock may be completely different from the market value of the stock price. According to Steve Nason, candlestick charting first appeared sometimes after 1850. Much of the credit for candlestick developments and charting goes to the legendary rice trader named Homa from the town of Sakata. It is likely that his original ideas were modified and redefined over many years of trading, eventually resulting in the system of the candlestick charting that we are using today. The candlestick charts are the pictorial representation which are an effective way of visualizing the price movements. There are two basic candlesticks which are the bullish candlestick and the bearish candlestick. The bullish candlestick is a candlestick which represents the close price is higher than the open price, and the bearish candlestick whose close price is lower than the open price. Each candlestick has four primary components which are open, close, high, and low. It corresponds to both the bullish and the bearish candlesticks. All the candlesticks will always have these four components which are in common. The upper stick-like pattern is termed to be a wick or shadow. When it appears above the candlestick, we call it to be an upper shadow or an upper wick, and when it appears at the lower end of the candlestick, it is termed to be a lower shadow or the lower wick. So in common, every candlestick will always have four components: open, close, high, and low. The length of the candlestick is termed to be the real body, wherein it may be longer or it may be shorter enough. There are three main components of the candlestick, which we termed earlier: the upper shadow, which is the vertical line between the high end of the day, and the close or open. The close can be in bullish candlestick and the open can be in the bearish candlestick. The real body, the difference between the open and close, colored portions of the candlestick is termed to be the real body. The lower shadow, the vertical line below the low of the day, and the open or close of the candle is termed to be the lower shadow. The shadows shall also be termed as wick. Here we see very few candlestick patterns in which multiple candlesticks forming reversal and continuation pattern. I may list about very few candlesticks which are the bullish engulfing pattern, the bearish engulfing pattern, dark cloud cover, doji pattern, evening star, morning star, hammer, hanging man, harami, inverted hammer, piercing line pattern and shooting star. First of all, we will discuss about the doji candle. The doji candle is one of a insignificant candle where many of the decisions are not being taken. In the doji candlestick, we have an upper wick, lower wick, open and close of the candlestick will remain at the same place, or at sometimes the body of the candle is very much significantly very lower. The doji candle represents an insignificant move where no decisions has to be taken. Here we see a long-legged doji. A long-legged doji is same as such of the doji candle, except the upper and the lower shadows are very much longer than the regular doji formation. In this picture, we see the open and close remain at the same place. We have a higher end of the wick and the lower end of the wick, which means that it will resemble a plus-like symbol. Examples of a long-legged doji. The long-legged doji will be a reversal pattern. In this chart, we see a long-legged doji which has been encircled in the yellow color, and after a long-legged doji appears, the trend intends to reverse and move in a higher direction. Next, we will discuss about the hammer pattern. The hammer candlestick formation is a significant bullish reversal candlestick pattern that mainly occur at the bottom of the downtrends. It has a long lower shadow, twice the length of the upper body. Sometimes we may have a very short upper wick and the lower wick is very much longer than the upper wick. In this diagram, we can see that the body of the candlestick is very limited or it is very shorter compared to the lower wick or lower shadow of the candlestick, and there is no upper wick found in this case. This is a classical example of a hammer in which at the bottom of a downtrend we can see a candlestick, we can see a hammer candlestick, which signifies the trend is going to reverse in the opposite direction, which is a significant mark where a buyer can take a buy position or a long position. There is always another trend, there is always a reversal of the hammer pattern where it is termed to be an inverted hammer. In such a case, at the lower end of a trend, it signifies there is a small change in the reversal of the trend, and it is an indication that lower or the falling of the nature has been stopped and the trend has reversed to the higher end. Next, we are going to discuss about the hanging man pattern. In the hanging man pattern, it is exactly similar to the candlestick which we see in the hammer pattern. The hanging man candlestick formation is a bearish sign. This pattern usually occurs at the top of the uptrends and it is a warning of a potential reversal downward. So we can see this hanging man at the top of an upper trend. We should be alertful and we should not go in the long direction. We should always wait, look for taking for a shorter direction or shorter position. It is exactly similar to the hammer position or hammer candlestick. There is a long lower shadow which should be at least twice the length of the real body. A classical example of a hanging man is that in the upper trend, in the upper level of a trend, we see a hanging man, and once a hanging man occurs in this pattern, the pattern or the trend intends to reverse itself and we see a significant downfall towards the bottom of the chart. Shooting star. The shooting star candlestick formation is a significant bearish reversal candlestick pattern that mainly occurs at the top of the uptrends. This shooting star pattern is a long upper shadow generally defined as at least twice the length of the real body. It is a reversal or it is an opposite case in terms of an hanging man or a hammer pattern. In this pattern, we can see the upper end or upper wick of the candlestick is very much longer than the body of the candlestick. And at some times, we can see a significantly lower or shorter lower wick or there shall be no wicks as we see in this case. A perfect example of a shooting star is that at an appropriate higher end or upper trend, when we see such a pattern, you should be alertful and you should not go any long position because the trend is trying to get reversed at one such point in time. After this candlestick appears at the top of the pattern or top of the trend, the trader will always go for a shorter position. During a short position, he can earn as much as possible profitability during the downtrend. Engulfing pattern. Engulfing patterns have one bearish candle and one bullish candle. The second candle must fully cover the first candle, either in terms of the bullish or bearish candlestick according to the second candle. In bullish engulfing candle, the first candle is a bearish candle and the next immediate candle should engulf the previous short candle or the red candle. It is reversal in terms of the bearish engulfing. In the bearish engulfing, the first candle is a significant green candle. The next candle completely swallows the immediate before candle, so that this signifies there is a reversal in the trend. Usually, the bullish engulfing takes place at the lower or the support area where it indicates a reversal of a trend from the lower to the higher end. Subsequently, in the bearish engulfing pattern, the bearish engulfing pattern will appear at the top end of the pattern, top end of the trend. Once the engulfing pattern happens, the trader must be alertful so that he should not take any longer position in the forthcoming candles. The bearish engulfing will remain at the higher end of the trend, which is at the resistance level, and when we see the bearish engulfing, when we see an engulfing taking place at the resistance level, it is a perfect sign of a bearish engulfing. Thank you.